My name's Gavin Lockyer. I'm Managing Director of Arafura Resources. We're an ASX-listed company that is focused on developing the Nolans Rare Earth mine in Central Australia. Rare earths are critical materials used in renewables and the e-mobility sector, and we've been advancing our project quite significantly in the past, mainly focused on capital raisings and our project funding.
Hello, Gavin. Good afternoon to you, sir. How's your weekend?
G'day, pretty good, thank you. Yeah.
Not too bad. You're struggling with the winter weather, 20 degrees or whatever it is.
It's not too good in WA through winter. We don't like it much.
Okay, well, we better talk business then. I'll warm you up. Okay, since we last spoke in the middle of April, I've seen a few press releases around money, financing, starting to move the pieces around on the board. The biggest of which is a recent $40 million raise. What was that for?
Yeah, look, we've got two funding streams operating at the moment. The first is around the immediate funding requirements to keep our working capital going, which I'll elaborate on. And then the second part is obviously the major project funding, of which we need $1 billion to build the plant. So the capital raising you alluded to, we successfully completed a private placement of 40 million Australian dollars to institutional and sophisticated investors, and the purpose of that is so that we can start our next phase of engineering, which is called front end engineering and design, or FEED, and this is a big chunk of work that will last for about 9 to 12 months, and once you start it, you don't really want to stop it. So we needed to be sure we had the confidence that we had the funding to see the process through, and that was the purpose of the capital raising.
Market didn't seem to like it. Shares dropped off a bit, got as low as 14.
Yeah, look, we did it at a reasonably deep discount, and it was just a sign of the market at the time. There seemed to be a bit of lack of appetite in the sector. I guess there's a bit of market fatigue around, a little bit of tax end selling before 30th of June, but we really wanted to keep the momentum going and so get the capital in the bank and keep the team together and keep the project moving along. We sort of have kind of justified it to a certain extent by offering our existing shareholders the opportunity to participate at the same price. And so we hope that goes a long way to alleviate some of the concerns that some of our shareholders may have felt when they first saw the announcement come out around the institutional placement.
So why go down the institutional placement route only? Was that just because it's such a big amount that you needed, or you felt you needed to do now before the end of the tax year?
Yeah, look, it's attracting that sort of capital from the retail market is pretty tough. Particularly, given the year that everybody's been living through in terms of COVID and uncertainty around markets. So the institutional interest was there, and we really also wanted to tap into some institutions that we felt would start to restructure our share registry, aligning it for the future when we do need to raise big capital amounts for the project finance. And a number of the institutions that have come on, we certainly hope this is them dipping their big toe in the water for, perhaps putting their hand in their pocket for bigger licks later on when we need it for the project finance. Okay,
so for people looking, because we've seen a lot of cross-exchange investing, okay, so much easier these days to do it on your phone, it's easy, but people don't necessarily understand the markets that they're investing into. So on the TSX, we usually see a little recovery after their tax loss season. Is it the same with the ASX?
Typically, yeah. It's people sell in May and go away because our end of year is 30th of June. So you typically in July start to see the market recover a little bit. So very similar to TSX.
Okay, fine. So you talked about, let's talk about what you're going to do with the 40 million bucks. You talked about working capital. What does that mean? Because you've got $1 billion project. That's kind of scary.
Look, as we've been working through the debt process in particular, so we're targeting, for the $1 billion, we're targeting government-backed or export credit agency financed debt syndication, and as a result of that process, we appointed Macquarie Bank towards the end of last year to assist us with the debt advisory, and we've been working with the Australian government and with other commercial banks and other governments globally around bringing together the funding package. And as we were working through that, it became quite apparent that given that it's such a big scale project, they would prefer to see more certainty in the pricing of our construction contract or the EPC contract. And in order to refine the pricing in that contract, we really needed to do a much more advanced what they call FEED, front-end engineering design study, which is taking our feasibility study, which is at a plus or minus 20% certainty around pricing, and taking that to a much more advanced stage where, we potentially will be heading out and getting vendor data. We've got quantities locked in. We've got the only thing that won't be locked in will be pricing. And so it will provide lenders a lot more confidence around the construction price that they will be lending us money to fund. And so that piece of engineering work we previously had earmarked within our DFS to be coming out of project finance. But as I said, as a result of our discussions with various financiers, they felt it best that we go ahead with a front-end engineering and design process that gives them more certainty, and therefore we get to hopefully a better result in terms of the debt structuring at the back end of that.
Okay, so two things going on here. You talked about, given the effects of COVID, the state of the market. So you're suggesting there that the market's a little bit depressed on that because of that. Yet we've seen sort of battery metal prices. If you look at the nickels and the coppers, even cobalts, they're shooting through the roof. What's happening in the world of NdPr?
Yeah, look, when I said the market's a bit soft, I'm probably referring to equity markets. The NdPr market has remained strong in terms of its commodity pricing. It's still up well over $70 a kilogram, which is it's sustained these levels for quite some time now, which is really reassuring. And what we're starting to see now from customers is that they may have had a strategy where they needed to look at their long-term procurement supply chain for battery metals as the ones you described, and they are saying that in the second half of 2021 they'll start to look at their long-term strategic procurement for non-battery metals, and certainly rare earths or neodymium, praseodymium is one of those. So we would expect that the commodity price should remain strong throughout the rest of this year, but also we hope that translates into some binding offtake agreements through the second half of this year as well.
Right. Well, talking of binding agreements, you've kind of got a soft MOU with a Chinese counterparty. You need, and we've talked about this previously, I think back in April even, and before that, you've got to make some decisions about which ecosystem you're going to feed into. So China, Australia have got a little bit of a trade war going on at the moment when it comes to commodities, all sorts of fun and games there. You're looking to Europe as well, certainly for some of these export credit agency type things. Are you any closer to making a decision about that, or is it just first come, first served?
Look, it's not a decision really. It's one that could be complementary. We actually have two MOUs with two tier one Chinese magnet producers, and these are existing producers that are providing predominantly non-Chinese auto sector, non-Chinese renewable sectors with their current magnets. And so because they're not necessarily 100% aligned with the Made in China 2025 strategy, they are also concerned about losing their market share and where they're going to source their NdPr from. So what we're actually looking at doing is talking to those customers in Europe, many of whom already buy magnets from these Chinese groups. But obviously we want to use the balance sheet of the groups in Europe because they're much, much stronger. And as you alluded to, they come with potentially government-backed or ECA financing from that particular country. And so we're trying to bring the three parties, us and the other two parties, together in order to potentially have tripartite sales agreements that are backed by the Europeans.
So what certainty are they looking from you? Because those are non-binding agreements, right? Is that right? Yeah.
Mm-hmm. Yep.
Okay. So you're going to have to do some work for them in Europe to maybe make them feel comfortable about giving you a binding agreement? Is that what you're saying?
Yeah, that's right. So we're looking to, or even if it's not a binding agreement, getting some form of letters of support that that those groups in Europe can provide to their export credit agency groups, such that those export credit agency groups can also then have discussions with us around a syndicated debt facility sitting alongside the Australian government. And we would hope that as we get closer and closer to the end of FEED next year, that we start getting the off-takers and the structured debt all starting to come together to a point where, you know, they're prepared to commit to each other and to us. So it's you know, it's not an easy thing, but it has been done before, and so, you know, we hope to be the next player in the market.
But with these sites, I want to sort of dig down on this one because it's important, because you're kind of at the rub here. You've got to put this massive financing package in together. And we'll talk about the Australian government $300 of support in a second. But with these Chinese groups, surely no Chinese operating company can operate without the support of the Chinese government. So whether they operate outside of the made in China policy or not, at the end of the day, they're going to be held accountable. And if the Australia-Chinese relations go even further south or sour even more, what do you do?
Well, I think a lot of these groups, not just Chinese, but many other companies, are trying to also build magnet capacity outside of China. Some are well underway and being built and constructed as we speak in Vietnam. And so, you know, we do have alternatives.
Such as?
Well, going to those factories through Vietnam or elsewhere.
But where are you now? I'm such a sense. So where are you with those discussions? Because are you having them in parallel, or you just got them in the back pocket just in case? And how do you play it?
Well, some of the groups we're already talking to have expansion capacity, have expansion aspirations, and so, you know, that's part of our ongoing dialogue.
Okay, so there's no competitive tension at the moment. The Chinese groups expect you to work with them, and that you're moving forward until you can't, or it happens.
Look, absolutely. I mean, as I said, they require a secure source of supply. We are able to provide them with a sustainable, secure, traceable product, which their customers demand. And I think you'll find that with a lot of the EU regulations that are coming in next year, a lot of the auto sector will have to look through their supply chain to see where the raw material is coming from. So whilst their magnet producer might be inside China, it still needs to know where its NdPr is being sourced. And that's the sort of traceability that Arafura can offer.
Right. And so let's come back to the 40 million. You talked about that being sort of like, you know, the front end design type stuff. I mean, how much more certainty does that give in terms of the cost? I mean, are you just shaving costs off here and there, or are people expecting to see 20% saving, or is it just about the certainty of pricing? And how on earth can you offer that? Because everything's getting more expensive at the moment.
It's around certainty of pricing, and so the process is you get an engineering group that comes in. They're reputable organisations, global organisations. We've currently got a tender process underway at the moment for that work. That engineer then has an alignment with a constructor, and between the two of them, they settle on what degree of, materiality they're prepared to offer in terms of fixed price. It may not be all fixed price contract, but vast majority of it should be able to be fixed, because you can fix quantities of concrete, quantities of copper, quantities of et cetera. And so the closer you get, and obviously the closer your construction period is to the end of that FEED process, the more certainty the constructor has around price. So that's why I'm saying by the end of FEED, we hope to have all the financing ready to go, such that we can just roll them over into fixed price contracts where appropriate.
So what you're saying is it'll give you more certainty about quantities of things, right?
Yep.
And at today's prices, it'll give you a sense of what you'd have to pay. But my point is, we've seen pricing go up for shipping, containers, fuel, staff, costs are going, there's lots of costs. There's a big moving market going on there. So at some point, the only time you're going to be able to fix that is when you commit to an order, and to commit to an order, what do you need to have in place?
Yeah, well, we need to have a lot more certainty around the project finance for one, but there's a number of things we can do in terms of once we are getting close, we can actually start placing, if the funding is there, we can start placing long lead item orders, so we can lock in those prices for key bits of equipment, and then obviously as it gets closer and closer to the date of final investment decision, that's when we can lock in and start hedging a lot of the pricing as well.
So it's a real juggling game, because you can't commit to stuff until your financing is in place.
Yep.
And you don't know when the financing is going to be in place at the moment. It's because there's a lot of moving parts there. Look,
yeah.
I know it's not easy. It's $1 billion capex. It's not an easy thing, right? You're not buying goods off a shelf here at a supermarket. But at the same time, I think what the market's looking for is an idea of when you think you can get this over the line, because you've been at the money side of things a long time, given the nature of the size of the project.
That's right. So just two things there. The first is that the banks will always factor in a working capital facility and a cost overrun facility. So whilst it's $1 billion, the amount of financing that we'll actually be seeking will be significantly more than that, to ensure that we can address any of those cost overruns that you referred to, whether it be inflationary or just scarcity of materials. So that's the first thing. The second point is when and what's our time frame. And as I said, FID or final investment decision will be end of FEED and aligned with bringing together all our debt packaging. We believe if we get the debt and the off-takers more or less aligned, that should cause a significant re-rating in our stock, we would hope, such that we can then go out and raise whatever equity portion we need at a significantly higher price than hopefully than what we're currently sitting at. And so FID we're targeting by the second half of next year, but we're still targeting production by the end of 2024. So none of that has changed from our DFS. We're just moving engineering work forward and allowing us more time to raise all the capital needed for the project.
Right, so and that's going to, what are we saying, 60-40? We're saying you need to raise roughly 40% equity. Is that the number we're looking for?
We're probably looking at 50-50 at this point in time. So, probably about 600 in debt and 600 in equity. That includes obviously the cost overrun facilities, contingencies, etc.
Right. So you really need a run on your share price. You need to drive, because what are you, let's say 170 million market cap at the moment. Mm-hmm. You need three times that in equity, 3 times that in debt. So that's a bit of a stretch at the moment, right? So what do you do? What do you do about that?
Well, that's why we've targeted a debt-led funding structure, and we knew that with a COVID world that it was going to be difficult to continue those discussions with offshore groups. And then the Australian government has announced its critical minerals strategy, and I'm pleased to say that that has accumulated for us in 2 letters of support from 2 different facilities, but a total of 300 million Australian dollars over long term, so 15-year facilities, subject to various conditions, and some of those are off-take, some of those are fixed price EPC contracts, et cetera. But that 300 million is basically the cornerstone of our debt package, which now allows us to go to those offshore jurisdictions, to the Europeans, to the Southeast Asian groups, and say, listen, Australian government's there. Your country needs this material for your manufacturing industry. There's clear evidence in the past that this is the way that countries like Korea, Japan, Germany, France, and others have funded projects through government support, through export credit agencies. How about you come in, sit alongside the Aussie government in this facility, and at the same time we'll be bringing along customers from your relevant jurisdictions.
Okay, so that's meaningful then. I mean, a letter of support. I mean, crikey. These things are, like I say, it's conditional. You did say it's conditional, so you identified a few things. How quickly can you draw that down? If you meet all the terms and conditions, can you draw it down, all of it, day one, or is it amortized over the course of 15 years? I mean,
those details haven't been factored in yet. This is really first step. so that they can continue with their due diligence on us. But the conditions precedent I've outlined are no different to any other debt facility that would be required for any other debt facility. So, as we get closer and closer, we'll start to refine the terms of those debt facilities such that they're all aligned, because if it's a syndication, it'll all have to be aligned, and it'll have to be aligned with presumably the chief facilitator. And so as we bring more parties in from Europe and elsewhere, we will sit those ECAs down together and start to structure the terms of the actual debt. Historically, though, debt providers want to be the last group in, so they'll want to see us the ability to raise the equity and spend the equity before we start drawing down on the facilities.
And how far do you? I mean, you want to get into production, don't you? Your team.
Yeah.
You want to get into production. Okay, right. So the strategy hasn't changed since we started speaking?
No, it's just advanced since we last spoke, because we have got those letters of support, and I guess the strategy in terms of project execution has changed, because we thought that we would be able to fund the project on the back of the feasibility study, but the financiers have said, no, we would like you to do more engineering, go and do the front end engineering to provide more certainty in the construction costs.
Okay. So what's the rest of this year hold? I mean, you're obviously going to do that work, but how long is that going to take?
Yeah, well, the FEED, we've got tendering process underway at the moment. We hope to appoint that in the next couple of months and get that cracking. That's a 9 to 12 month exercise. So that's the project team now. I can set and forget them and let them get on and do what they need to do. And so the rest of the business is now 100% focused on the commercial aspects, being offtake, debt financing, and obviously marketing to bring potential investors along for the ride and make sure that they're ready for when we want to push the button on that equity raise next year.
Okay. And I know we've talked about export credit agencies, but are you seeing a lot of funds? Because we're seeing a lot more of these ESG green funds around, and they're looking for deals and they need to place big projects here. I mean, are you having those sorts of conversations?
Yeah, definitely. Look, those types of funds are becoming more and more interested in our sector, and it's as I said, as a result of the fact that we're a project that's in Australia, we've got all our environmental approvals in place. We provide traceability not just in where the product is coming from, but also where is the waste being managed and how are you rehabilitating your site, and that's becoming a really, really big factor for a number of these ESG funds. And I think you'll only see more and more of this coming to fruition in the coming years, because, as I said earlier, the EU in particular is bringing in legislation around provenance of supply and making sure that there's anti-slavery provisions being factored into your supply chains and so on and so forth. And Arafura can offer that, and we're actually working on some blockchain-like technology to be able to trace our block of ore and be able to provide our customer with a line of sight as to where that magnet or the NdPr in that magnet has come from, this block of ore back in Central Australia.
That's really interesting.
And that's something really that is getting a lot of interest, particularly with European customers.
Yeah, absolutely. And I think we're sort of seeing it coming out the other end as well. It's almost like commodities are going to be leased or rented rather than sold because they want to be able to track it through its life, whatever that means. I'd love to dig into that a little bit more with you at another time. That sounds fascinating. Blockchain as part of the mining process. Are you? We've also seen a few companies come on here and try and describe themselves as not mining. We are we're moving downstream for that re-rate. Are we going to see that from you?
Well, I mean, I never thought we were a mining company. We were always been a minerals processing company because we were always going through to a rare earth oxide 15 to 20% of our cost is mining, both operating and capital cost. The bulk of the cost is in the minerals processing. So we are a minerals processor. We are a downstream processor. It's just sometimes we get lumbered in with the resource stocks. And look, even our name, as historically we've been Arafura Resources. That's something that we're also considering, whether we look to a name change to make it a little bit less resources and more focused on what we actually are, which is a high purity oxide producer.
Yeah, you've got to be careful though. You don't want to be accused of greenwashing through branding.
I understand.
We've seen some companies come on here, lithium brine companies, and say we're a water purification company. I thought that was clever.
Okay. Yeah. Okay.
It's just an idea.
No,
you can have that.
No, thanks. Well, there's plenty of companies that have changed from being resources to Bitcoin to medicinal marijuana, but no, we're certainly Arafura Resources, and our focus is the Nolans NdPr project.